So we are recording, so I can start swearing now. So we have, this call is just to go through strategy 13, which is a new strategy that we're adding for 2020. So we'll be presenting this at the LA event in about a week's time, and then in the UK event in March, and in Singapore in April. And I think at that point then as well, we would have done the first couple of deals using this strategy, which means we will then publish this video for the wider community. So I'll stick the video in the app once there's the, the kind of working case study there. But I thought I would just run through the basics of it, because I think it could be a very interesting strategy for 2020, and particularly as we've made it quite clear that we want to help as many Harbour Clubbers as possible to have 7-figure exits to create 50 new millionaires in 2020. And I actually see this as being a really key strategy to achieving that, because of the potential that it has. Now, obviously, you're all familiar with agglomeration, and if companies fit the profile for agglomeration in that they're profitable, well-run, debt-free, well-established, the owners are committed to staying with it over the long term and benefit from the bonus shares and all of that sort of stuff, then agglomeration is the perfect target for those businesses. But in some instances, agglomeration isn't the perfect solution. So, for example, if you have a business that has some leverage in it, so they have debt associated with the company, maybe it's a faster growing company, therefore they still have debt associated with the fast growth, and therefore it's not going to work as an agglomeration target. Maybe the guy running it's just an egomaniac and isn't going to fit in with a nice collegiate group of people in an agglomeration. They are somebody that is just one of these maverick out there kind of entrepreneurs who just won't play well with other children, and would be better off in their own sort of isolated place. Or maybe it's a slightly unusual industry, like technology or something that's a little bit unusual, that agglomeration wouldn't want to take that growth risk on, but actually could have huge potential. It could be a really interesting business. So there are lots of those kind of businesses that wouldn't necessarily fit in agglomeration that we think strategy 13 could be really useful for. We also think it's a really useful strategy for doing roll-ups or building groups. Now, this is a really important point, because what a lot of people do when they're building a group is they feel they have to put a big group of companies together first and then go do something, whether that's doing an IPO or selling it to a private equity company or whatever the end goal is. And you've probably heard me say numerous times before, it's much harder to build a group and go public than it is to go public and build a group. Because if you're already public, it's much easier to attract people to come and join you, because you have that credibility and that sort of status already, so that it's easier to get people to come and join that particular party. You also have the benefit of being able to issue your own currency by effectively issuing new shares to do acquisitions. And it also gets past that kind of disbelief that some people might have about you actually being able to achieve it. So some people would be genuinely skeptical that an IPO would come at the end, because it seems like one of those kind of entrepreneur bucket list things that lots of people say they're going to do but never actually do. So having done it, you kind of dispel all of those doubters immediately by having something that's kind of already there. And so this is where this kind of strategy 13 kind of came about, which is, simple ways to take companies public. Now, what we found out when we were listing MBH is that listing SPACs, so a SPAC is a special purpose acquisition company. It's effectively an SPV that's publicly listed. Listing SPACs is getting harder and harder. Most exchanges either don't allow them, or they put so much regulation around listing the SPAC that it's actually harder than listing an operating company. And then once you actually get it listed and you introduce a deal to it, they then want you to recomply with the exchange as if you were listing that company that you're reversing into the SPAC. And so it's almost like doing 2 IPOs instead of doing 1, to use that kind of the SPAC route. So that kind of old-fashioned idea, or the way of creating cash shells and reversing deals into, has got extremely hard. However, part of the about a year and a half ago, Spotify listed on the New York Stock Exchange, and they used a listing method called a direct listing. And a direct listing is simply where you disintermediate the corporate finance and investment banking route, and you simply apply as a business directly to the exchange and say, we would like to list on your exchange. Now, the exchange has a bunch of criteria, and basically if you meet the criteria for listing on the exchange, then they're minded to accept your application, and away you go, you're a listed company. One of the drawbacks with a direct listing is that you then have to create a market for your shares, which would normally happen through the IPO process. Yeah, there's a whole bunch of work that you have to do yourself that the investment bank would normally do the heavy lifting on. Having said that, what was really interesting is that after Spotify did that particular listing, the European Union thought that they should put some regulations in place for what happens if lots of people want to do these. In July 2019, they passed a bunch of regulations around the topic of direct listings. And what was really interesting, I think this is quite common with European regulation, is it's absolutely riddled with loopholes that can be abused. So I think they tend to release legislation first and then possibly think about it once it's been used for a few months to see where the problems is. I guess that's kind of how they test out iOS, isn't it? When they release it now, they just mass release it, fix the problems later. Basically, the loopholes are quite interesting. So what you can actually do now is, if you're raising less than 5 million euros, you don't need to issue a prospectus. So basically, if you don't do a capital raise in association with the listing at all, you basically don't need very much at all. You need a business description, which is like a written business plan, basically. Now, obviously, the business plan still has to go into quite a bit of depth. There's still all the usual disclosures that you would have in a prospectus. But the difference is, in a prospectus, you normally have to have all of the audited numbers, but then the audited numbers need to be approved by a reporting accountant. And then all of the wording needs to be approved by a lawyer. And then the law firm and the accounting firm kind of sign off on the prospectus, and then it has to be signed off by a regulator as well. And it's that process of going backwards and forwards between the regulator and the lawyers to agree the final wording and the nitty-gritty and the questions that they want to ask. That's the bit that really runs up the bills and also runs up the clock. So you can spend an awful lot of time batting a prospectus backwards and forwards to a regulator, and you can also run up massive legal bills in the process. So if you take out that part of an IPO, that's by far and away the largest part of the listing process in time perspective, and probably the largest single use of professional fees. You can quite easily spend 150 to 300,000 euros on a prospectus by the time it's finished and approved by the regulator. So if you can take that 150 to 300,000 euros cost out of the equation, and the months and months and months that it takes to actually get the thing listed, then that obviously makes quite a big difference. Now, generally, all of the rules around what you can list are basically the same. So, it should be a company that has 150 shareholders. No more, those 150 shareholders shouldn't have more than 3% of the company each. So if you have a large shareholder, you then need 150 more who have smaller shareholdings. You have to have an ISIN number and an LEI number. I'll come on to all these things in a minute. You have to have a Clearstream registration if you're listing in Europe, or Euroclear if you're in Sweden. But an electronic share registrar for the trading of the shares. You have to have all of your accounts must be audited. Now, this is the interesting wording. So it says all of your accounts must be audited a minimum of 3 years, or however long the company's been in existence. And so effectively, if you think about that, what that means is, if you're a 10-year-old company, you need 3 years of accounts. If you're a 3-year-old company, you need 3 years of accounts. If you're a 2-year-old company, you need 2 years of accounts. And if you started it 4 minutes ago, you just need the audit from 4 minutes ago. So that's quite a gaping loophole, because effectively you could list a company that's just started and it can meet the audit threshold, because the audit is, all the audits that are available up to 3 years, depending on how long it's been formed. So that's an interesting loophole. So what we found out when we were trying to list another is that they were getting obsessed with what business we were going to buy once we're listed. Now, obviously, the point of a SPAC is that you list this kind of opaque vehicle, and you then reverse in whatever asset that you want to reverse into it. And but the exchange kept coming back and saying, well, what's the asset you're going to buy? What's the asset you're going to buy? And so you have to start showing them some transparency around, deal flow and things that you're looking at, which completely flies in the face of listing a SPAC. But when we dug deeper with the exchange, what we realized is what you could effectively do is you could create a brand new company. So create an SPV. Now, I mentioned to you all those things you need to have to be a listed company, like the LEI number, the ISIN number, the Clearstream registration, etc. Now, all of those things, when you apply for them, are slow and painful things to apply for, and you have to jump through all the ins and outs and all the compliance and all of the normal, crap that you would have to. Let's say you're opening a bank account or something like that. It's a very similar kind of process in terms of disclosure and the things that you have to show them in order to get each of these numbers. So what we found is that if you create a brand new company and it has one director and one shareholder, at that point, you can then apply for the LEI number. And on the LEI number, they want the passport, the bank statement, the business plan, all of that stuff. But it's for one shareholder and it's for one director. And so very quickly, you get your LEI number issued. Same when you come to your ISIN, same when you come to getting your Clearstream. There's almost nothing that they can ask you about the company. So it's very, very quick to get through all of those kind of compliance stages. Now, if you were doing this with a normal business that you wanted to take public, this could take a couple of months of providing information, particularly if you have a complex share register or several directors in the business or a couple of overseas directors or something like that. It starts to get really, really messy as you go through all of those things. So you have your LEI, you have your ISIN number, you get your Clearstream. You do your audit because the company's only been going for 5 minutes. So you apply for your audit, which is going to be very quick and easy to do. Just basically saying, yes, it was only formed 5 minutes ago and it's done absolutely nothing since it was formed. That's signed off by the auditor. So you now meet the audit requirements, which is a little bit alarming, but true. So you now meet the audit requirements and then you get your Clearstream. So that means the shares are now dematerialized and they can be delivered to the electronic share register, so they can be traded once you're listed. And then the next part is the interesting bit. So effectively, you have your target company. So you have the company that you would like to take public. So this could be an LBO that you've done. It could be a business you're already sitting on. It could be a business that you've sourced that you want to joint venture with people on. What we then do is we effectively sign a term sheet with that acquisition at an agreed valuation. So, let's just say you had a little software company, it had a little bit of debt on it, but it's growing very fast and it, could dominate its particular world and it's making, $1 million a year of annual profits. So we would go away and we would get a valuation based on that particular company. And let's just say it came up at 8 million as a example. So we would then, as long as the owner of that business was happy with the 8 million figure, we would then get a term sheet put in place and we would then approach the exchange that we wanted to list on. Now, the best exchange to list on in Europe at the moment is the Xetra, which is where we've listed MBH, because you get the, the volume and you get the depth of market there. But to front door list on the Xetra is really, really painful. They list about 200 companies a year. They're very busy, they're very fussy, and you get all of the normal resistance you get from a main market. So another happy side effect of the European Union is that you have these EU passports, or the ability to passport between different exchanges. So there are a whole bunch of other EU regulated exchanges where you can list your company and then effectively just passport it over to Xetra. So for example, two that we've identified that look quite good are the Luxembourg MTF and the Austrian Direct Plus market. And both of these have a direct compatibility with Xetra, which means as soon as you're listed on those exchanges, 24 hours later, you can have your shares trading on the German Xetra. It's a really simple process where you just appoint a sponsor and the shares are trading there straight away. So that's a really nice backdoor to get the business onto the Xetra. very quickly. And if you're listing on the Austria Direct Plus, they do about 20 listings a year. And the rest of the time, I think they're sitting around playing solitaire. So it's very easy to get a meeting, to pitch the idea to them, to get them really excited about the fact that you want to come and list your company in Austria, and generally just be very, very helpful. So effectively, you then pitch them the idea that you want to list this SPAC, but that as soon as you're listed, you're going to reverse this, or at the same time as you're listing, you're going to reverse this other company in, and you can give them the full transparency over what that other company is going to be, and that there's no risk to investors because you're not raising money at the point of listing. So there's no prospectus. So effectively, it's a direct listing application. Now, what's interesting is because the direct listing application is to list a SPAC, not to list the company that's the target, then you get around having to comply as the target. And what's really interesting here, and this is probably not something that I would take advantage of, but what's really interesting is that the exchange requirement is to have 3 years of audits, or as many years as you've been trading, audited. But once you're a listed company, you can more or less do what you like. You can buy whatever companies you want. So effectively, the company that you're listing is the shell. It can buy anything it wants. So if it wanted to buy an unaudited company, it could buy a company that didn't have any audits. It could buy a startup. It can buy anything it likes. Now, obviously, you have then reporting periods. So at the end of the year, you're going to have to report your accounts, and that's going to need to be audited. So you might find that you get delisted or moved to a different exchange or something like that if you then didn't comply in the future. But theoretically, you could list a completely non-reporting, non-audited entity using the structure that I've just described. So effectively, we set up a SPAC. We get all of those clearances. We reverse the other vehicle in, and the deal that we do with the exchange is that we're going to reverse this other vehicle in at the same time as we list. And now, from the approval from the exchange, it's about 2 weeks away from listing. So we believe that the entire process from start to finish, so if you take a typical timeline for a listing and you strip out all of the things that you now don't have to do, then it basically brings the timeline down to about 45 days. Now, I don't believe in any way that it will actually take 45 days. Our experience so far is that it's probably going to be more like 90. But still 90 days to list a company from start to finish without having to produce a prospectus, without having to go through all the onerous, KYC and other parts of it, we think can be quite an interesting approach. And the other thing is that you can pretty much pick the valuation at which you list. So you can choose the value that you list at. Obviously, the valuation you give the target company when they reverse into the business, that creates the capital in the company. The profit that you and I can make effectively is the difference. So we retain a stake in that SPV, which we can aim for sort of 20 to 30% of the overall vehicle. So if they believe they get 8 million for their business, they would still get their 8 million, but the overall vehicle might be worth 12. And then, like I say, you pick your share price and you list at that price. And the concept is that the market then decides what the real value is. So if people think it's overvalued, then the price will go down. And if they think it's undervalued, they'll buy it and it will go up. Now, obviously, what's actually going to happen is you're going to list and nobody will know that you've listed. There's no razzmatazz, there's no big explosion or fireworks display or anything like this. When you list, you just appear one day on their index, and people who are, really bored and looking through their share trading app will suddenly notice that there's another ticker has appeared on their list that they can now buy. So it's really important at this point that you invest in some market making, that you actually invest in promoting the stock and getting people interested in the story and what you're trying to do. And so that's a whole other story. And we've got some, obviously with MBH, we've gone through lots of different machinations of doing things with that. We've managed to generate some pretty incredible volumes on MBH as well. So we think we know some things that don't work, and we know some things that do work when it comes to promoting it. But where I see this strategy being really, really easy to apply and sexy is if you're looking to do a roll up and you have a company already, then let's direct list it now and use it as the vehicle to roll up the other companies, because it's much easier then to target those other companies by listing that first one and getting it off and running. The second application would be if you're looking to do a leverage buyout, or you're looking to pick up a business that wouldn't necessarily fit into an agglomeration, but you would still like to do something to get some value and some liquidity. And the advantage again with this strategy is I think you're going to get a pretty punchy valuation on the company itself, because you're going to get effectively a public company valuation for a small private business. And also there's going to be a reasonably short run to liquidity. So with one of the ones that we're doing just now, we're doing a group of franchise owning businesses. So they're a franchisor, or they buy franchisors. So they've bought 3 of them so far. And with that particular business, we've done a deal with a market maker where effectively they get the exclusivity to market the shares for the first 90 days, for the first 9 months. For the first 9 months, they get exclusivity to market the shares. But what we can do is we can put shares into a trading pool with them that they will sell on our behalf. And they use a big chunk of that money that they're selling to reinvest in more marketing, so that they drive more volume and create more interest in the stock. But it does mean you can also take some cash off straight away. So pretty much, that company should list in the next 4 to 6 weeks. And basically after it's listed, within a few weeks of being listed, first bits of cash would start to come off the table from that business. So this is not only a way to get a really decent valuation, but also can be quite a quick way to get to liquidity. It can be quite a quick way to get to the position where you're actually taking some cash off the table. So I think this can be really exciting. I would still look for reasonably chunky businesses to do this with, so kind of €1 million plus of annual profits, just because we want to try and get the highest possible valuation. But we can look at all the things that we wouldn't look at in a agglomeration, like sort of sexy technology stuff, or fast growth, or crazy change the world type products. This can be a really good home for those kind of businesses, or a business that you've bought and it just happens to have a load of leverage on it. We can still, as long as there's enough profit there, we can still do a decent deal using this structure. So I think it's going to be a real game changer this year. Like I said, we've got the first 2 going through right now, and as soon as they're done, then I think we'll open the floodgates of the community in terms of bringing these kind of transactions to the table. So if you have any questions, there's a little chat button down the bottom of the screen. You can click on the chat button, type in a message, and I will jump on any questions that you want to ask. There's a few of you I'm looking at on the screen here as well. I think you pretty much have deals that could go pretty soon. It'd be interesting just to see what the feedback is, or whether you've got one that's ready to roll that we can look at. The other thing that we're doing at the moment is that Unity is financing all of the listing. So effectively, to the target company, it's no cost. To yourself, it's no cost. So we finance the creation of the SPAC and all the legals and all that stuff, because we've literally just gone through the process. We're doing, as a trial, I think we picked about 4 or 5 of these last year. We whittled it down to 2 that we would do as an experiment. And we're listing one in Austria and one in Luxembourg, just so that we've tried both of those routes to figure out which exchange is the nicest to us, which one has the best coffee. And so we can figure out which one we're going to use again in the future. So nothing coming through on the chat. So I've muted you all, but if you do want to ask a question, you can just unmute and ask. But otherwise, I will draw us to a bit of a close if there's no further questions. Susanna, want me to unmute you?
So Jeremy.
Go on. Yeah.
Yeah. So Unity is taking the cost of the listing on. Yeah. Mm-hmm. And what about later on to market the whole share price, the business, and the story? How you see that this could be pretty much get financed and done, and because we need to, if we were acquiring, we probably need to bring the shareholder the share price up to acquiring others. Yeah.
So we can normally come up with a valuation that is very acceptable to the target company. It's normally much higher than they would get in a private sale. So it's quite appealing for them. The management team, the people running the business, will be subject to a lockup. So they'll have to have a lockup of 12 months. but they can put some of those shares into that pool of shares that are sold through the market making activity. So they can still take a bit of cash off the table as long as it's pre-agreed before we start the process, not decided after listing, because once they're listed, the shares they have in their account are the shares they have in their account. Yeah, and then we cover the listing costs, and we obviously take a stake on the SPV side, which we would share with you guys as well. So you know, these can be pretty meaty. We looked at one. It actually didn't go ahead, but it was quite a nice techie company, and we pinged it over to one of the guys who does the stock promotion, because we wanted to do it that way around. We wanted to see which one they wanted to promote more than which one we thought was the better business. And this one they really liked, but the owner didn't want to do anything with it just yet. I think that one was doing about 1 million in EBIT, and they reckon they get 15 to 20 million of market cap for that business. So, you know, if the owner was happy with 15 and we took 5, that's still quite a nice deal for everybody. Yeah, and then you put it to the market maker. Now there are several different ways they can do the market making. So we have a market maker that does email marketing. So they create, you get analysts to do reports on the stock. So you get an analyst to cover the company and do the analysis of the company, and that's all, you know, very standard. You would do that anyway for any company that you're listing. You know, MBH has a couple of analysts covering it. But then what you do is you pay this internet marketing company effectively to drive traffic to those reports. So effectively, they take highlights from the report, they turn them into adverts, and they drive people to read the rest of the report, and then that gets people to come on and buy the shares. And that actually worked really, really well in the early days of MBH. We got quite a lot of volume from doing that, basically Google ads and paid advertising. The other one, which we didn't try with MBH, but we're trying with another company that we're listing, is the traditional kind of telephone based. I don't want to say boiler room, because they're not actually selling shares. They literally just ring up investors from investor registers. So they look at the institutions and the individuals that have invested in other companies, because you can pull the share registers from other companies and see who the investors are. And they literally ring them up and just say, hey, look, you've invested in this company. Here's one that's similar. You know, we think you'd like it. Would you like to invest in it? And again, they've shown us several companies that they've worked with, and that's been quite successful, but it's incredibly expensive. So you invest a lot of money in it, but it can generate a lot of volume, and it can generate some really good quality investors. So it might be something, again, where you segment off a chunk of shares and you use that chunk of shares for them to pay for that activity. So effectively, it's still kind of self-financing, because they'll sell the shares and it's the money from selling the shares that pays them. But still a lot of, you know, that you'd invest quite a bit of money in it. Yeah, and then there's a couple of other methodologies which are along those kinds of lines. But yeah, there's several different routes that we can use to drive it. And the other one is, you know, the small cap funds that we've got now. We've got a few small cap funds that are investing in MBH as we speak. They have allocations they can invest in small cap, and we can easily get them to invest in other small caps that we've got listed, as long as the story stacks up and the deal's right for them. It doesn't detract anything from MBH, because it's a percentage of total funds under management that they can issue to one target effectively. So with the ones that we're working with, they will max out what they can do with MBH, and if we want any more from them, then we have to present another idea to them, basically. I'll just read some of the questions we've got here. Is profit the most important number? Also size. I have a £20 million company right now, but only a couple of % of profit right now. However, potential to increase profit. Yeah, I think if we've got the scale there and they've got a story, again, you know, profit's nice, because when you're a listed company, you do have to pay to be listed. You know, there's we cover all the costs of listing, but existing as a listed company, there's obviously costs associated with being a listed company that they would have to pick up, like the ongoing auditing and reporting costs, and the investor relations costs that have to go into stuff. So yeah, I think some profit is good, but also the story is important. because obviously the most important thing is how we can sell the idea to the marketplace. So selling the idea to the marketplace, it's got to be a really interesting business, or doing something that's that potentially has a big market, or you know, can be very, very good in the future. So that's kind of important. Susanna's asking, is it EBIT or sorry, is the EBITDA euros or GBP? Doesn't matter so much. It could even be a little bit less than $1 million, again, if the story is right. Yeah, we're looking for yeah, good quality businesses that are doing something interesting. So then, would this strategy work for distressed acquisition, debt to equity swap? It's not necessarily a good distressed strategy if it's a bit of a messy distressed one, but if there is if there's a good underlying business, I mean, if they've done a debt for equity swap, for example, and it's now got a nice clean balance sheet and it's profitable and it looks good, then yeah, I'm sure we could do something with it. We'd have to just have a look at it and see what could work. But yeah, it doesn't really work for a basket case type transaction. Yeah, and then that question is just a repeat. So anything else from anyone else? No? Okay, right, well, let's leave it there. I think, yeah, if you have any deals that meet the criteria, that, you know, profitable, well run, decent amounts of profit, or a really sexy business story, something that's interesting, maybe a technology or something that's got a fast growth potential, or just doing very well, do reach out and drop me a line about the concept, and we can have a look at it. Yeah, see whether we can do it. And if you're considering doing a roll-up, or you're in the process of doing a roll-up at the moment in any sector, this is a really great way to get the roll-up kicked off, because we can do the direct listing, gives you a listed vehicle that you can start with, and then you can just start rolling the other companies into that listed vehicle. So it kind of gets you there much quicker. Okay. Well, thanks very much for joining us. Like I say, you've got this information a little bit early, so you've got like probably a 3-month window you can run at this before the rest of the Harbour Club hordes are descending on us with loads of I said hordes, not anything else. So before they descend on us with lots of other stuff. So I will leave it there. Have a wonderful Monday evening. Speak soon. Ciao for now.